Hello, my name is Bob Boylan, and I am here to do a problem-solving session. In this case, it's the problem-solving session for problem set 2. As you will see in a second, I have selected 6 problems from problem set 2 that we are going to review in this session. What you will see is, again, in the problem sets, there are easy questions and hard questions. Any question that has a T in front of it, that T represents the fact that it was an old test question, and a question very similar to what you can expect to see on exams that you will be taking. Now, for problem set number 2, and in this session, we're going to be doing a question which is labeled T10 in your problem set, so you will need to have that in front of you to reference it. Problem set, or question 10 is bad debts. If you come back down real quickly, let's go through exactly what we're going to be doing. So we're going to be going through questions 10, 12, which is present values, 13, which is accounting errors. Now this question appears on virtually every test that Boylan has ever given. Accounting errors also appears on virtually every midterm exam Boylan has ever given. In addition, present values appear in some form or other on virtually every exam that I've ever had. And in this case, question T10 is similar to, but not the same as, question T18, which is also bad debts. So in my opinion, this bad debts question is sufficiently complicated that it made sense for us to do 2 examples of bad debts expense. And last, 16 is a fairly simple inventory type question. So let's get started. The first question that we're going to be discussing is question 10. And I have question 10 so we can review the basic information. The bad debts question 10 gives us a large amount of information. Now the key is going to be able to organize this information in a way that makes it reasonable and easy to come to the conclusion we're looking for. What conclusion are we looking? What's the question? And the question is, what is the ending amount of bad debt expense for the year? That is what we are searching for. Now, in an effort to explain what's going on, what this company does is it uses 2 methods to calculate bad debt expense. During the year, this is for quarterly statements, things like that, they use a percent of sales, right? In this case, 0.9% of credit sales is used as an estimate for bad debt expense. Then at the end of the year, when they have time to evaluate and look at what their receivables actually are, they go back, analyze receivables, and in the past they have determined that roughly 3% of their accounts receivable is a reasonable estimate for how much is going to go bad. Now what that means is that 3% of accounts receivable is their estimate for the allowance account. Now, so you estimate the allowance account at the end of the year, and once you've done that, you then back into an adjustment for bad debt expense. So bad debt expense may be above or below what was originally estimated using the percent of sales method. So again, a 2-step process. During the year, for quarterly statements, this firm uses a percent of sales because it's quick and it's easy. At the end of the year, they analyze receivables, and they've come up with this number, which we're making easy. In reality, firms analyze each receivable and do what's called an aging of receivables and come up with a number. Our proxy for that is simply 3% of accounts receivable. That 3% is then the ending balance in the allowance account. From there, once you know what the ending balance should be, you then go back and adjust bad debt expense with an adjustment as of the end of the year. And what we're looking for in this question is the ending balance or the final amount of bad debt expense that would appear on the income statement as of the end of the year. Okay, here we go. Now, anytime I do this kind of a question, what I do is I draw a picture. And you've heard me say that in other problem-solving sessions. The key, in my opinion, to organizing information is to draw a picture that allows the information to be readily visible. Here we go. The picture that I draw for any bad debt expense type question has 4 T accounts. The first T account is a T account for accounts receivable. And accounts receivable is an asset account, therefore debits or increases, credits or decreases. Another account that directly relates to the bad debt expense area is the allowance account. And it's the allowance for uncollectibles. Now, the allowance account is a contra asset account. Hence, since it's an asset, debits or increases, credits or decreases, but since it's a contra account, it has a balance contrary to what you would expect. Now, assets generally have a debit balance. A contra asset is going to have a credit balance. In addition, again, I'm setting up the framework. In addition, I use sales, and I use that simply because receivables and sales are related. And lastly, I will use an account called bad debt expense. Now, sales is an equity account. Debits or decreases, credits or increases. Bad debt expense, this is a D, again, is another equity account. So the equity accounts are on the right. The asset accounts are on the left. And debits are a decrease to equities as a whole. Credits are an increase. Now, what I'm going to do is I'm going to go back to the basic information and start filling in the blanks for this question to get the information organized. And what I physically do when I do these things is I go through and I cross off the information. Now, the fact that credit sales were $400,000, right, is something we need to think about. Collections on account $350, write-offs of specific accounts. Accounts receivable beginning balance. Let's start with that. The beginning balance in the receivables account is $60,000. The beginning balance in the allowance account is $3,000. Let's put those in. So $60,000 is the beginning balance in accounts receivable, and $3,000 is the beginning balance in the allowance account. Remember, it's a contra asset account, hence has a balance contrary to what you would expect. The allowance account has a credit balance, even though it is an asset. So I have now checked off those things. Collections on account, $350,000. What that means is we recorded some sales. So let's record sales. What entry would have been used to record sales? And the answer is we would have debited accounts receivable for $400,000. And we would have credited sales for $400,000. And that is that number right there. Collections on account were $350. So collections on account would have been cash coming in the door, so we would have debited an asset called cash. We would have credited the asset accounts receivable because they no longer owe us the money. So the credit there goes to accounts receivable. Now, write-offs of specific accounts is $2,000. What's the entry for that? And the entry for that, this is the write-off of specific accounts, and the entry is what has happened is you have gone through your accounts receivable ledger and you have identified those accounts which in fact are going to go bad. You know they're bad because they are not paying. Hence, you need to reduce credit accounts receivable for those specific accounts. Now, what has happened is in the past, you've already estimated that, in fact, some accounts were going to go bad, and now all we're doing is going, yes, we were right. Some accounts are going bad. We've simply identified those accounts. And so this 2,000 of bad accounts is included in the amount we've previously estimated, which is included in this allowance number right here, the 3,000. So the entry for that is a credit to accounts receivable and a debit to the allowance account. Notice that the write-off of specific accounts is not an expense, and it's critical to understand that at this juncture. We have not estimated any expenses yet. We're about to do that in terms of this question. So, up till now, let's review what we've done. Go back to the basic information. I've now made use of all of this information. It's time to start thinking about the way they record bad debt expense. And they use 0.9% of credit sales. So credit sales were $400,000. 0.9%, 9 times 4 is 36. So the entry they would have made during the year for bad debt expense would be, again, 9 times 4 is 36, 3,600 would have been their estimate of bad debt expense for the year, and the balance of that entry, the other leg of that entry, so the entry would have been a debit to bad debt expense and a credit to the allowance account. And so we would then credit the allowance account, 36. Now, before this firm would look at adjustments as of the end of the year, right, this is before, what would their balances be? And their balance in bad debt obviously would be 3,600. The balance in the allowance account, however, would be, let's see, 3,000 minus 2,000 is 1,000, be 4,600. This is the trial balance before the adjustment. Now, as of the end of the year, what happens is we go in and we say we total up the receivables, and when we total up our receivables, we add all this stuff up, and what we find is that, if I can read right from my notes, that the ending balance should be 108. And that makes sense, 40, 64, 60, okay, looks good to me. So the ending balance in the receivables account would be 108. And then what we know is that the ending balance in the allowance account should be what? Should be 3% of the ending balance in accounts receivable. So we come down here and we look at what the ending balance in the allowance account should be. And the ending balance should be 3% times 108, and that turns out to be 3,240. So the ending balance should be 3,240. Notice that's an ending balance, a nice double line. And I'll take this line down, right? This ending balance comes directly from the ending balance in accounts receivable. Again, critical to understand that relationship. Now, are we finished? And the answer is no. Because in our allowance account, per our trial balance, we have a balance of 4,600. Yet, for our analysis told us that this balance of 4,600 is actually too high. The balance in this allowance account really should be 3,240. Hence, we have to change this account. We have to make an adjustment. And the adjustment would be what? The adjustment would be to go from 46 down to 3240. We would have to debit this allowance account, and I'll do it in blue. This is our adjustment for 1360. Now, what is the rest of that entry? And the answer is, well, we debit the allowance account, and we credit the bad debt expense account for 1360. Now, what that then gives us in the end, after our adjusting entry of 1360, is that the ending balance in bad debt expense, or the balance that would appear on the income statement, should be 2240. And I'll put a nice double line there. And 2240 is our answer, which is the ending amount of bad debt expense that would in fact appear on the income statement as bad debt expense after the adjustment. And the adjustment came why? Because we adjusted it relative to an analysis of the receivables. Now, again, the key to this question is to understand the flow. What flow did you see? The first thing I did was I drew a picture. The next thing I did was I put in all the information that I could that was given in the question. The third thing I did was I dealt with the bad debt expense, the estimate as a percent of sales. The next thing I did was to do an adjustment as of the end of the year for our adjusting process, which is that the allowance account is contingent upon accounts receivable. The ending balance in the allowance account was 3% of accounts receivable. Okay, so much for question number 10. Next question. Next question is a fairly easy one, back to our roadmap. And question 12 is the next thing we're going to talk about. And question 12 is just trying to get you to think about a simple present value rate of return. Question 12. Here's the information. Kirby Puckett is considering investing in a project that has a cash flow, this is an after-tax cash flow, so don't worry about any accounting complications, of $10,000 per year at the end, and again, key here, the end of each of the next 5 years. The price of the asset is $35,000, and Kirby's opportunity cost of capital, in other words, what does that mean? The rate of return Kirby has to be able to hit in order to be able to accept this project is at least 15 or more. And so the question then asks, what is the rate of return on this project? And should Kirby invest in this project? So here we go. Now, in general, there are two ways to evaluate projects. One way is to calculate what's called the net present value, which we are not going to do in this case, but which you will see in future examples. The second way, which we will do, is to calculate what's called the internal rate of return. Now, these particular, and these are finance terms. The net present value is often called the NPV, and the IRR is the internal rate of return. So what we are asking you to do in this particular question is to calculate the IRR, calculate the internal rate of return on this particular project. Now, how do you calculate the internal rate of return? And the basic format is fairly simple. You set the present value of the cost equal to the present value of the benefits, and the benefits in this case are cash inflows. And then you solve for, right, the question is, what is the interest rate or the rate of return that equate the cost and the benefits? Now, in this case, what are the costs? The cost in this case is the initial cost of the asset, which is $35,000. And what are the benefits? The benefits are a stream of cash flows. So I'm going to draw it as a picture from periods 1 through period 5. And the amount, and at the end of each period, so the picture looks like this. So what's going on is this is the present value of an annuity, and the annuity, the amount in here is $10,000. So it's an annuity of $10,000 per year for 5 periods of 5 years. And the question is, what is the interest rate, right? And that is the question. So if we equate 35,000 to the present value of an annuity for 5 years and solve for the interest rate, what we find is that the interest rate is approximately 13%, give or take. Now, how should you do that? And in my opinion, the way to do that is to use a calculator, not necessarily this calculator. I know you can leave me in the bottom right, but a calculator to do the present values. You also have available the tables that we have handed out. But for instance, this particular calculator, which is an HP12, which is the one I use, or you know, most HPs work very similarly. Again, I'm just going to show you how to do it because sometimes this gets confusing. The first thing I'm going to do is I'm going to clear everything. So I'm going to hit F of clear financial stuff now. In this case, 35,000, and I'm going to change the sign on that, make that negative, is the present value, or the amount today. And 10,000 is the payment per period, which would be that amount right there. 5 is the number of periods, and I'm solving for the interest rate, which I just hit I, and it's now solving for the interest rate. So while the computer was running, I thought I'd tell you a story about, I'm kidding. Come on, computer, go, 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 go. So the rate of return we just solved for using this simple handheld computer calculator is 13.2. So a more accurate would be 13.2%. And I hope that makes sense because it's a fairly straightforward process. And now the next question is, should they accept this project? And the answer is, well, their required rate of return is 15%. This project has given them a 13% rate of return. No, you should not accept this project if your required rate of return, if your hurdle rate is 15, because you're only going to get 13 on this project. So much for the next question. Back to our roadmap. So we'll come back to present values and do a loan question in a little while, but for now let's talk about accounting errors. And accounting errors, this is a situation where the firm made an error as of year end. So here comes the question. And this is question T13, problem set 2. And the error is listed right here. The error for this company is that the ending balance in an inventory account was understated by $10,000. So what that means is it's an asset, right, at the end of the year is $10,000 lower than it should have been. It was stated at 90, it should have been 100, for instance. That's the basic idea here. Now, it's very important to keep track of the dates in these kinds of questions. Notice here that the ending balance inventory as of 12/31/91, the year 91. Now, required, compute the effect each error had on the 1992 net income. Okay, so question number 1 is, what's the effect on 1992's net income? And the next question is, what effect did this error have on the 1992 balance sheet? Okay, here we go. So, Boylan's first rule for doing any kind of a question is what again? Draw a picture. Here's the picture I use anytime I'm analyzing this kind of a question. And the picture is one of inventory. And I use boxes. We have some beginning balanced inventory plus purchases. And that's going to be equal to cost of goods sold plus ending balance. Now, let's put in the basic information. For 1991, what's going on? The beginning balance, as far as we know, was okay for 1991. The amount of purchases were recorded okay. But the problem was that the ending balance, right, back to the question, the ending balance is understated or it's too low by $10,000. So if this is too low by $10,000, in order for this equation to hold, and this is again 91, what has to have happened in 1991? And the answer is, well, if the ending balance is too low and they recorded everything else okay, then cost of goods sold would have had to be too high, or in this case, the expense involved with office supplies. So this then was too high. This again is too low. And so if there's an error in one item, there has to be a corresponding error in some other item. And that's the key insight to begin with. Now, have we answered the question? The answer is no. We haven't answered the question yet, because what does the question ask you? The question asks you, what is the effect on the 1992 net income in the 1992, which is the next year? So in the year following the error, what is the impact on the income statement? So let's take this analysis from 1991 out the next year to 1992. So, if the ending balance, again, remember this has gone undetected, if the ending balance in the inventory count was too low, then that means the beginning balance in 92 is what? Is too low as well. Why was that? Well, because your ending balance is, by definition, your beginning balance the next year. Now, in this question, purchases were recorded okay. There's nothing to the effect of the ending balance being incorrect, so the ending balance in 92 is okay. But what happens is, if the beginning balance is too low, in order to get the equation to balance out, what has to happen? Then cost of goods sold in year 2, in this case 92, is going to be what? It was too high the previous year. It's going to be too low, again by 10,000 in this case, in the second year. So the question then asks, what is the effect of net income, or the effect on net income in 1992? And the answer is, well, if cost of goods sold is too high in year 2, that means the expense is too low, therefore net income is too high. And again, ignoring taxes and whatnot, it would be too high by $10,000. So the first part, what is the effect on net income in 1992? The expense in the second year would be too low. However, that would cause net income to be too high. Now, the second part of this question is the tricky part. What happens to the balance sheet in the second year? Well, let's go back and talk about the first year. In 1991, what happened to the balance sheet? What happened was the asset was too low. So if we go back to our accounting equation, assets equal liabilities plus equity, and everything in accounting revolves from that, then what we found out was that an asset account was too low. Right? The ending balance inventory was too low, therefore an asset was too low. Liabilities were okay. And if the left side was too low, then cost of goods sold was too high in 1991, therefore net income was too low. Net income flows into retained earnings, so equity through retained earnings was too low. That's the only way the equation can balance out, because the assets were too low, equities had to be too low Again, that was for 1991. That's not the question, however. The question now is, what about 1992? And the answer is, in 1992, if we go back to our diagram, in 1992, the ending balance is okay. Therefore, we go back to our accounting equation. Assets equal liabilities plus equity in 92. Assets are okay. And it turns out equities are okay. Because what we have is what's called a counterbalancing error. Cost of goods sold was too high in the first year by 10, too low in the second year by 10. However, the net effect on retained earnings is that these two errors counterbalance each other, and there would be a zero effect on retained earnings. Hence, the balance sheet in year 2 would be correct, even though the income statement in year 2 in 1992 would in fact be off. Well, I hope that makes some sense. So again, the key thing here, let's go back and review what I just did. The key thing is to first draw a picture, organize the information, make sure you know exactly what's going on, and some of the tricky parts of this question is you have to understand that the beginning, unless otherwise stated, the beginning balance is okay, purchases are okay, and then get to the relationship at hand. The second tricky part is to remember that the ending balance in one year flows into the beginning balance the next year. And then you go through the analysis in a step-by-step process. Hopefully that makes sense. Next insight. In the second year, if the expense is off, therefore net income is off. In this case, if the expense is too low, net income is too high. However, on the balance sheet, we have a counterbalancing error. Hence, in the second year of any error, the balance sheet would be correct because the error would have counterbalanced. So much for question 13. Back to our roadmap. Back to a present value question. Right? This is a present value, and we need to do present values to be able to figure out what the loan expense is. So, question 15. Don't know where that came from. You are considering purchasing a car and must take out a loan. The car, a Lexus, has a cost of $35,000. You have $6,000 in cash and must finance the balance. The market interest rate is 12%, and you plan to make quarterly payments for 5 years. Question 1. What is the quarterly payment? Question 2. How much of the second quarterly payment is a reduction of principal and how much is interest? And so the key insight here is that when you are making payments on a mortgage or on any kind of a loan, part of those payments are going to have an impact on the balance sheet directly by reducing the outstanding balance of the loan, and the other part, which is called interest expense, has an effect on the income statement. And so the question here is, of the amount you're paying, the annual payment to the finance company, how much of that is an expense on your income statement? Now this has very practical importance for anybody who has a mortgage, because all that interest, and only the interest, not the total payment, the interest is tax deductible every year and gives homeowners a huge tax break. Okay, here we go. So, what's our basic plan? Boylan's basic plan is always the same. Boylan draws a picture to help organize the information. Now, in this case, what we have is a picture of a present value. Now, the amount you're going to borrow is how much? You're going to borrow the $35,000 cost less the $6,000 you already have. That looks like $29,000. So you're going to borrow a total of $29,000. Now, the amount you're going to borrow is equal to the present value of a stream of payments. So the picture for that is that you're going to borrow a certain amount right now, and that's the 29, and you're going to pay back the loan, looks like that. And in this case, the details are what? This is payment 1 through there. This is a loan for 4 years. There's quarterly payments, hence there is 16 quarterly payments. So in this case, the present value goes from period 1 through period 16. Now, the interest rate on this loan. The interest rate on this loan is 12% per year, but we don't use a yearly interest rate, we use a quarterly interest rate. Divide 12% by 4 quarters, we get 3% per period. So 3%. So in terms of Boylan nomenclature, what's going on is the present value, in this case 29, is equal to the present value of an annuity of some amount, and that's what we're trying to figure out, for 16 periods at 3%. Now, once we solve that, that will give us the answer to question number 1. And rather than, I'll just look this one up. Each payment is $23.09. So the annuity is $2,300.09. That is the amount of the payment per period. So there are 16 payments, each of $2,300. So obviously you're going to pay an amount in excess of $29,000. That was the answer to question number 1. Question number 2 is, let's go back to the question. Question number 2 is, what is the quarterly payment? That's 1. Question number 2, how much of the second quarterly payment is interest, and how much of it reduces the outstanding balance? Okay. So in order to do that, I'm going to take a new piece of paper, and I'm going to create what's called an amortization table for a loan. And the amortization table has the payment, which we know is $23.09. A certain portion of that payment is interest. A certain portion of that payment is a reduction in the principal, the amount of the loan. And then lastly, we're going to keep track of the actual loan itself. So this is the liability of the principal. Now the initial principal was how much? The amount we borrowed? $29,000. Now, in the first quarter, quarter number 1, they pay $23.09. Now, of that $23.09, how much is interest? And the answer is, well, how much interest are they paying? They're paying 3% on the outstanding balance at that time. $29,000 times 0.03 gives us $870. So $870 is the amount of interest. Now, $870 from $23.09 gives us $1,439, which is the amount of the reduction in the principal. Add that to the initial balance, and we get that the new ending balance at the end of the first quarter is $27,561. That's the amount we owe the bank if we were going to pay this thing off at the end of the first period. Now, at the second period, how much is the payment? It's an annuity, the same payment every period, $23.09. How much of that payment is interest? Well, now the amount of interest is the same percent, 3%, except for now it's 3% of $27,561. So $27,561 times 0.03 is $827 roughly. Rounding to whole numbers. Subtract that from $23.09. I get 1482. And then if we then subtract 1482, which is the reduction from 27,561, we get 26,079. So the question was what? The question was, on the second payment, how much is interest? And the amount that is interest is 827. How much reduces the outstanding principal? The answer is 1482. Now, for the year, what would happen? And for the year, given that this was the first quarter, in order to get interest expense on the income statement, you would simply total up the 4 quarters worth of interest, and that would then give you interest expense for the year for this particular loan. Now, that wasn't asked in this particular question, but again, that's an important part of accounting, that you understand that the present values affect the actual accounting, which is the amount of interest that would be necessary on the income statement. Back to our roadmap. So much for question 15. Question 16 is a fairly simple question, in the sense that it's fairly straightforward. Question 16 is an inventory question. And the inventory question is, we have a certain amount of purchases. On May 1st, we purchased 2,000 units. Then on July 15th, we purchased another 1,000. Then we sell some. Then we buy some more. Then we sell some more. And the question is, calculate the ending inventory and cost of goods sold under each method. Now, what are the methods in question? The two methods that we care about are LIFO and FIFO. Now, we could also conceivably do weighted average, but we'll concentrate on LIFO and FIFO in this example. Okay. So the process for this is fairly straightforward, and all we do in LIFO, FIFO kinds of questions, the key is to remember the layering. So in attempting to answer this question, the first thing I'm going to do is draw a picture to help me organize. And anytime I do inventory, I use 4 boxes. So I'm going to have a beginning balance plus purchases is equal to ending balance, cost of goods sold, plus ending balance. Now, in this case, notice it says the Pierce Company started operations in May 1992. So I'm going to assume that this May 1st amount was the beginning balance. So the beginning balance is 2,000 units at $10, or a total of $20,000. And again, taking that right from the sheet. Then purchases. The purchases, there was 2 layers of purchases. One layer is the 1,000 units at $12, and the second is, the second purchase is 2,000 units at $14. Now, in addition, there were sales during the year. And the sales during the year, which is items going out the door, they sold 1,600 units in August, and they sold 1,000 units in December. So the first thing I'm going to do with this basic information is to keep track of the units that in fact transpired. So here we had a beginning balance. I'm going to draw a little line here. In terms of units, we had a beginning balance of 2,000 units. Then we increased another 3,000 units, 1,000 plus 2,000. That's equal to the amount that went out the door, in this case 2,600, plus the ending balance. Well, 5,000 which was available, less the 2,600 that they sold, gives them 2,400 units left over. And hopefully that makes sense. Now, in order to be able to evaluate this, if we use FIFO, then the items that went out the door are valued at a first in, first out basis. So FIFO is what we'll do first. And on a FIFO, we keep very careful track of the layers. So in this case, from a FIFO perspective, cost of goods sold is going to have all 2,000 at 10, and it's going to have, the next layer would be the 1,000, an additional 600 at 12. Now what that then means is that the ending balance has one layer, the balance, which is 400 at 12, plus the last purchase, 2,000 at 14. So again, fairly simple question. Now we just add these things up and we get the cost of goods sold using FIFO as well as the ending balance using FIFO. And I hope that makes sense. Again, this again is a fairly simple question. Now, LIFO. LIFO is last in, first out. So if we value this on a LIFO basis, let's go back and make sure we understand that this 2,600 units is the number of units, 2,000 plus 600, that we're valuing for cost of goods sold under one method, FIFO, and we're going to value the same thing, the same 2,600 units for LIFO, but now we're going to use a last in, first out. So for a last in, first out scenario, which is the LIFO, we take the last items in, which are the 2,000 at 14. They become the first items out as part of cost of goods sold. So 2,000 at 14 become the first items out, plus an additional 600 at the next to the last layer out at 12. Then in ending balance, we have another 400 at 12 because 1,000 was this middle layer. And then in addition, in the ending balance under LIFO, we have the initial amount of 2,000 at 10. And so we simply add these things up, and that gives us our amount of cost of goods sold or amount of ending balance. The key thing in doing inventory type questions is to keep the layering straight. In this case, the layering, LIFO, last in, you go to the bottom and you layer, the last ones in are the first ones to go out. FIFO, the first ones in are the first ones to go out. And you just keep track of that layering effect, then inventory questions become extremely easy. The second part of this question is they ask you, or the question asks, which method should they use? Now, the method they should use depends upon what their goal is. And it turns out that whatever method you use for tax purposes, you must use the same method, LIFO or FIFO, for GAAP purposes. Now, what does that mean? Well, remember that for tax purposes, what is our goal? For tax purposes, our goal is to minimize the amount of tax that we give the government. And the way we minimize the amount of tax is by maximizing our expense, minimizing taxable income. Hence, for tax purposes, we would choose the method of inventory that gives us the highest amount of cost of goods sold. We go back and review which method that would be, and obviously, in this example, with prices of 14 and 12, in a period of rising prices, LIFO would give you a higher cost of goods sold hence would give you a lower net income, hence you would pay less in tax. Hence, if you were trying to maximize cash flow in a period of rising prices, you would choose LIFO. However, again in this example, in a period of rising prices, if you were trying to maximize net income, and net income, as we all know, affects stock valuations. So if you're trying to maximize net income, then you would choose the cost of goods sold that was relatively smaller. And the relatively smaller cost of goods sold in a period of rising prices is going to be given to you through a FIFO calculation. So the answer to the question depends upon what the company is trying to maximize. If it's trying to maximize net income, then they would use FIFO to get a higher net income in this example. If they're trying to maximize cash flow through a tax analysis, then they would try to maximize the amount of cost of goods sold, minimize taxable income, and they would be using LIFO in this example. Now, last question. What do most firms in fact do? And the answer is most firms are concerned about the cash flow ramification, and at this point most firms would use LIFO under these conditions in a period of continually rising prices. So much for question number 16. The last question for this particular session is another bad debt expense question. And it's a question similar to the first one we did. We're going to use similar processes for solving it. But notice this time, the question is not what is the ending balance in bad debt expense. This time the question is, what is the adjusting entry? Now, on question 18, there's also a second question. What if the amounts that were previously written off suddenly, in fact, are paid to us? How do we account for that? That's a fairly easy part to the question. The hard part is, let's go through and make sure we understand the basic flow of information for doing bad debt expense type questions. Here we go. Remember, I didn't go through the actual information because I'm going to check it off as I go. Now, the format that Boylan uses is what? He uses 4 T accounts. And the T accounts are what again? Accounts receivable, the allowance account, sales, and bad debt expense. And this is our estimate. Bad debt expense. Assets, allowance, and accounts receivable. Sales, equity account, bad debt expense, another equity, negative, positive. Now, we go through and we stick all our information in. I'm going to start out with accounts receivable beginning balance, 504. So over here, 504. That's the beginning balance. Allowance for uncollectibles, beginning balance 26.4. So the beginning balance 26,400. So cross these things off. 504, 26.4. Collection, credit sales, 360,000. So we put that in. 360,000 is our credit sales. So 360,000 is a credit to sales and a debit to accounts receivable. And we'll cross that off. Collections on account, 355,200. So collections on account would be a debit to cash, that account's not up here, and a credit to accounts receivable for 355,200. And coming back here, I cross that off. Write-offs of specific accounts, 7,680. Write-offs of specific accounts, 7,680, would be a credit to the accounts receivable account, 7,680, and a debit to the allowance account for 7,680. So we've crossed off the write-off. And sales returns of 7,200 would be what? Would be a decrease in sales, 7,200, and a decrease in receivables for 7,200. Okay. And so what we've done is we've used all the information. Now, what this question says is that at year end, 6.5% of accounts receivable is used as an estimate for the allowance account. So in this case, this company uses just one method for estimating bad debt expense. They did not use percent of sales early on. They simply used a percent of receivables account as of year end. So in this case, we go through. We first have to calculate the ending balance in accounts receivable. And the ending balance, once we add everything up, is $493,920. That's a nice double line telling an ending balance. And before we make any adjustments, what happens, and I don't have a number for that, the allowance account has a balance of what? So before we make the adjustment as of the end of the year, the allowance account, 26,400 less 7,680 is 18,720. That's before our adjustment. Now, our adjustment is what? Our adjustment is that the ending balance in the allowance account should be what? And the ending balance should be 6.5%. So it's 6.5% times 493,920. Now, as I am looking at my answers to this kind of, so when we make this adjustment, excuse me, let me get. When we multiply this thing through, what we find is that the ending balance should be 6.5%, 6 times 5, let's see, 493,920 times 0.065. I get 32,105. So the ending balance should be 32,105. Now, in order to go from 18,720 up to 32,105, we can subtract 18,720 from 32,105, and we get 13,385. And so, in order to bring it up from 18 to 32, we have to increase the number in the allowance count, or credit the allowance count by 13,385. So, the entry then is what? Is a debit to bad debt expense for 13,385 and a credit to the allowance account for 13,385. And that is the answer to question number 1. And the question was what? What is the entry that the firm would make? And the entry is debit bad debt expense, 13,385, credit the allowance account, 13,385, and it would be made as an adjustment at year end. Now, part 2 of this question says, suppose, right, of the amount that we had previously written off, suppose someone pays off someone sends us a check, sends us cash, which is manna from heaven. How do you record that? Now, you've previously written it off, right? You went to the accounts receivable account and looked at that particular account, and you wrote it off, and you said, okay, this person's never going to pay us. You wrote it off. It's not listed in your list of receivables anymore. But all of a sudden, you get a check from this person who you thought dead. So, what entry do you make? Well, what are you getting? You're increasing an asset called cash. For how much? Who cares? What's the other half to this entry? Well, the other half is we have to increase an equity account. It's an income statement type account, and it would go into something like miscellaneous income or miscellaneous revenue or whatever. It doesn't matter. In any case, this would end up increasing our net income as of year end. Well, that brings us to a close for this particular problem-solving session. And again, I think that the bad debt expense question is sufficiently problematic that we did 2 bad debt expense type questions and 2 present value questions. And you can expect to see those types of questions on exams in the near future. Thank you very much.